Since the beginning of the year, the stock market has been heavily influenced by one key metric, and that is the consumer price index. Never have I ever seen the market be so influenced by one monthly number. It's been absolutely insane in 2022. However, more on what CPI is in just a minute. But the CPI data reports have single handedly changed the way that people are investing in 2022. And in my opinion, I think that there are flaws in this. And I truly believe that anyone looking at this metric to solely make their investing decisions on, they're making a huge mistake. The Consumer Price Index measures the monthly change in prices based off of US consumers, or in a word, inflation. So, in other words, the CPI index is also an inflation indicator that's closely monitored by policymakers in financial markets, which is why this has been so closely tied to what the Fed and good old Uncle Jay may do when it comes to interest rate hikes. The CPI is based on about 94,000 price quotes collected monthly from some 23,000 retail and service companies, as well as 43,000 rental housing units. There are subcategories to this as well, which is just crazy. Just considering how much data actually gets collected every month, and the subcategories come from anything from fruits and vegetables to just how much it costs to fix your car, and even sporting events. Don't get me started on my Ravens tickets. We've seen some incredible numbers from CPI as it's increased by 1% in May of 2022 and was up 8.6% year over year then. The scary part is that the White House just indicated today that June's number is likely to be even worse and will indicate inflation that we have never seen before. In fact, White House Press Secretary Karine Jean-Pierre told reporters that she expects new consumer price index data to be highly elevated and may come in at record highs as inflation is projected to be up 8.8% year over year in June. It's pretty tough stuff. While this may appear as though things may be getting worse, and in some cases they are, but there are some flaws in this CPI data that I think should be noted. The first one is that CPI is a lagging indicator. We're getting June numbers in the middle of July, and believe it or not, a lot can change between what happened last month and what's going on right now. And there are forward-looking indicators that may actually be telling us that inflationary pressures may leave much faster than they have arrived. Over the weekend, the Wall Street Journal put out an article that points out the risks of the Fed taking its foot off the interest rate accelerator too soon and leading to a stop and go resurgence of inflation that we saw back into the 1970s. According to the journal, stop and go refers to how the Fed oscillated between raising rates to tame inflation and then backing off to shore up growth, succeeding at really neither one of those. My hunch here, though, is that Uncle Jay and the Fed will subscribe to that idea and keep the foot on the gas, which may lead to a much harder landing than the soft narrative that they've been speaking to. But here's the kicker. What if the script flips? And what if there's so much attention on inflation that you don't see the economy is weakening, and that will itself help actually contain inflation? That's an exact quote by Donald Cohn, who was the vice chair at the central bank and worked there for 40 years. And then having lived through this during the 70s, I thought this was an interesting take from him. So many others who've lived through the 70s are kind of calling for a repeat here and really encouraging the Fed to just go all in. And here you have Mr. Cohn saying kind of the opposite. According to macro research from Fundstrat, stopping or slowing would have very little impact on about 80% of what makes up CPI. This includes home prices, food, cars, energy, and especially jobs. Another issue with only using CPI is that commodity prices aren't really taken into account. Agricultural prices such as wheat, cattle, corn have all plummeted. Remember lumber skyrocketing? That's been cut by over 50% from its highs as well. And energy, as we have seen as of recently, is also falling. One of the biggest inflation bubbles was used cars, which have never been higher as it relates to new cars. But we're already starting to see this bubble burst as well. According to a recent report from Barron's, car repossessions are occurring at an alarming rate, and used car prices are $10,000 above expected levels, and nearly 12% of car payments are greater than $1,000 a month. That is insane. I don't know who wants to pay $1,000 a month for a car. I cannot fathom that. I almost wonder if we're going to see a 2008-like crisis in car loans, similar to what we saw in mortgages. Let me know in the comments what your thoughts are on this and where this could be headed, because I think that this is a narrative that not a lot of people are really speaking to. Regardless, there are all deflationary, and CPI hasn't yet caught up to these factors. As I'd mentioned before, CPI also doesn't take into account that jobs are playing a factor here and that they are indeed dropping off in areas that are impacted by monetary tightening from the Fed. Even though June's job report wasn't all that dramatic in terms of job losses, it's worth noting that 10 of the 20 industries with the most job reductions in June were from banks, retailers, and housing related areas. This is showing that a rise in rates are already impacting parts of the economy all by itself. So, what does all this mean? I guess for me, it's one of those things where I could see us heading into a recession right now. But if the Fed continues to keep their foot on the accelerator pedal like they are, we see another 75-point rate hike and another one after that, and there is just no let up. My concerns are that we are already seeing deflationary factors happen. And then you have the Fed coming in and doing the exact opposite of what they did last year. And it is just going to create an even deeper recession next year in 2023. Right now, we're seeing a bit of a slowdown, and I think it's something that the economy and the markets can handle. But if they keep going down this road without any let up, I think 2023 is going to be extremely difficult for a lot of consumers out there like you and me. Let me know what you think, though. Has CPI become overrated, or should it continue to be relied upon in this market? Let me know what you guys think, and I will see you tomorrow.